The biggest reason why 90% of retail traders lose money. If 90% of retail traders are losing money, then the real question is, why are so many people still jumping into the markets every single day? Are they just gambling, or is there something deeper going on that most people never realize until it's too late? What if the biggest reason traders fail isn't what you think? In this video, we're going to break down the hidden mistakes that destroy trading accounts and reveal the truth behind why most retail traders lose money. So stick around, because what you're about to learn might just save your portfolio. Insufficient trading strategy. Clarity. Lack of a structured trading strategy is one of the most obvious problems among retail traders. Many people enter the markets without a clear strategy on how to approach trades, following advice from friends, internet gurus, or emotional whims. They may follow pricing patterns they don't fully grasp or make trades based on a feeling. Some people make the mistake of replicating tactics they come across online without modifying them to fit their own objectives or risk tolerance. Traders are left to fend for themselves in volatile markets without a blueprint. This frequently results in inconsistent behavior, rash choices, and large losses. Traders need to create and follow a thorough trading plan that includes the following: criteria for entry and exit, levels of take profit and stop loss, guidelines for risk management, preferred trading periods and resources. Before any actual money is at stake, the efficacy of backtesting techniques can be confirmed using previous data. One can only expect to be consistently profitable by approaching trading like a business, complete with risk assessments and organized strategy. Ineffective risk control. The majority of unsuccessful traders have one thing in common. They are fixated on making as much money as possible, with little regard for the potential losses. Ignoring the drawbacks can lead to financial disaster very quickly. The reason it's an issue is that markets are by nature unpredictable. Unexpected volatility, market manipulation, or news developments can cause even the most carefully thought-out trade to go awry. An entire account may be lost in a single poor trade if safeguards weren't in place. Good risk management is necessary, not optional. Traders ought to. Just 1% to 2% of their trading capital is at risk in each trade. Put stop-loss orders in place for each trade. Instead of investing all of their money in a single asset, diversify. If you are not experienced, stay away from trading during highly volatile news events. Focus is shifted from gambling to strategic investing when each trade is viewed as a component of a long-term portfolio rather than a single win or lose wager. Emotional decision-making, emotional ecosystems make up markets. Prices are influenced by the emotions of thousands of individuals in addition to the basics. Regretfully, a lot of retail traders are influenced by their own emotional biases, such as fear, greed, hope, and regret. Emotional judgments frequently take precedence over rational ones. Traders may leave too soon out of fear, losing out on earnings. They may stay in losing transactions longer than necessary out of greed, hoping for a recovery. After a few victories, overconfidence can result in excessive risk-taking. Discipline and experience are the keys to developing emotional control. Here are a few useful pointers. Perhaps more crucial than learning any technical indicator is learning to control one's emotions. Excessive trading. Inexperienced traders frequently mistake activity for output. They think they will make more money trading more. Overtrading results from making too many trades, too frequently based on poor setups. Overtrading raises market exposure, which raises transaction costs and increases the chance of losses. It frequently results from impatience, boredom, or an obsessive urge to do something. Pay attention to settings with a high chance. Take a quality over quantity approach. Only make transactions that satisfy all of the predetermined criteria by using a trading checklist. In trading, patience is not only a virtue but also a need. Miscommunication. Make use of leverage. There are two sides to leverage. It increases losses just as much as wins, but it also enables traders to manage larger positions with less capital. Make cautious use of leverage. Recognize how margin operates and figure out each trade's maximum possible loss. Leverage should be started low and increased only as consistency and experience increase. Insufficient training and experience. Though few people realize it takes the same amount of dedication and education as any other industry, trading is sometimes perceived as a quick route to fortune. Traders are effectively gambling if they don't comprehend market dynamics, indicators, patterns, and tactics. They are more prone to make rookie errors like misinterpreting news events, trading against momentum, and disregarding trends. The answer is to set aside time for education. Take online courses, watch tutorials, read books, and get advice from reliable mentors. To get experience without risking real money, practice on demo accounts. Even after you start making money, you should keep learning since markets change and traders should too. Ignoring the psychology of trading. Many traders ignore the psychological side of trading in favor of concentrating just on technical and fundamental analysis. However, trading is a mental game just as much as a strategic one. Put just as much effort into improving your mindset as you do into your approach. Journaling, mindfulness, and meditation are techniques that can support the development of emotional resilience. Use case studies and literature to learn about trading psychology. Identify trends in your behavior and take proactive steps to address them. Market chasing, FOMO. One of the most prevalent psychological pitfalls in trading is FOMO, or the fear of missing out. Because they are afraid of missing a rally or decline, traders frequently enter positions late, after a significant move has already taken place. Following trends without getting enough confirmation raises the possibility of buying high and selling low and creates bad entry points. Remain true to your trading strategy. Let a move go if it doesn't meet your requirements. Keep in mind that there are countless opportunities in the markets. Selectivity and discipline are more crucial than making every deal that comes up. Excessive dependence on social media and tips. Trading communities can provide knowledge and insights, but they can also serve as a haven for false information. For trade ideas, many retail traders mostly rely on internet forums or social media influencers, frequently taking recommendations without conducting their own research. The majority of advice isn't customized for your capital, trading style, or risk tolerance. Ignorantly, copying the trades of others frequently results in poor timing and misaligned tactics. The answer is to use forums and social media as supplementary resources, rather than as primary sources. Always do your own research and double-check assertions. Create your own plan and put your judgment above unidentified counsel. Inability to adjust. Markets are ever-changing. Investor sentiment, political developments, and economic data can all change quickly. It is possible for strategies that are successful in one market setting to lose their effectiveness in another. Traders who steadfastly adhere to antiquated practices or disregard shifting market conditions frequently end up on the losing side. Access to better tools or secret indicators isn't what separates the losing 90% from the winning 10%. It's the capacity to manage risk, grow from errors, and engage in disciplined trading. You may steer clear of the common mistakes and forge your own route to financial success if you're prepared to treat trading with the gravity it requires. If you're serious about leveling up your trading game and avoiding the mistakes that wipe out most beginners, hit that subscribe button and turn on notifications. We break down real strategies, honest insights, and everything you need to trade smarter.